working life. You just save and invest for that period of time. You don't have to be the right time.
You made the point even more drastically over the weekend in terms of looking at treasuries, U.S. treasuries, basically said there's never been a good time to buy it, even going all the way back to the war bonds back in the 40s.
Yeah, that is true. Now, you bought them for patriotic reasons, but the government then was offering you 2.9%. You bought a U.S., you call them a war bond, then they called them defense bonds, and then savings bonds later on. But we were happy to buy war bonds then, and we paid $18.75, and we got $25 in 10 years. For 3 gets you 4. That was, in fact, they took "Take Me Out to the Ball Game" and turned it into a song about buying war bonds, you know. And for each 3, you get 4 at the old bond game. And there's literally a song, and we'd sing it at school. And the government happily pointed out to you that you were getting 2.9% compounded for that. And of course, now you have a situation. The Federal Reserve says they want inflation of 2%. So they say they're going to try and devalue that bond by 2% a year in the dollar terms. And it's almost always equities have been a better buy. And certainly if you're going to put away money over time when you're younger, if you buy stocks over a considerable period of time, you're not going to get the lows, but you're not going to just buy at the highs. And if you buy a cross-section, well, like I say, it'd have turned $10,000 into $51 million, and you'd never have had to look at a financial page again or listen to a broker.
Going back to this idea, though, that the markets, you think, are a good place for average investors right now. The S&P 500 is a good place. If you're a professional investor, if you're somebody like you look at prices and you think what?
Well, I look at prices and I find it hard to buy things. And incidentally, professional investors aren't going to do better than the amateur in almost all cases. But I don't find things easily. I mean, we were on in March of 2009 when the Dow was in the 660s or 670s. And we talked about it then. I mean, it was the bargain counter. And it continued for a long time. Stocks have been very, very cheap. But you have to measure them against alternatives. I mean, if government bonds got to 15% like they were in 1982, that's a different equation against stocks than exists now.
You've had periods in the past, though, where you have said stocks look expensive to you or that we look like we're in bubble-type territory. This is not one of those times, I take it?
This is not one of those times. Now, if government bonds go to 7 or 8%, which means if you own a long bond now, you get killed, the stock you bought now will not necessarily look attractive. It probably won't be attractive. I mean, interest rates are like gravity. If interest rates are 1%, and they're going to be that for 100 years, obviously anything that yields you 2 or 3% is going to do way better. But I don't think they're going to be 1% for 100 years.
Just to get into the nuances again, though,
yeah.
You're talking broadly about issues in terms of how you see the stock market as a great place for average investors, maybe a place where you're not finding all that many bargains. And when you look to buy a company all in, I mean, I've spoken with some people here this weekend who know an awful lot about M&A, who know a lot about private businesses, what they're valued at different things, who say that when they're looking at prices, things look really rich. You're talking about prices that are 15 to 20% above what's a fair price as they see it. Is that match up with what you see right now?
I would agree with that. That's why we haven't bought any businesses for quite a while. In addition to the normal factors in the public market, when people buy businesses these days, frequently they're being bought by people that are borrowing 60 or 70% of the money, maybe even more.
You're talking about private equity?
Mostly private equity, but not exclusively private equity. And we're not willing to calculate our returns based on borrowing money at 70% of the purchase price. That may be the best thing to do, but we calculate things generally on an all equity basis, and we are not competitive. And then you've got a general euphoria that, to some degree, the private equity funds have to put the money out, and it's kind of interesting what they do because They take the money which they get usually from institutional investors, and then they buy a company in the market from some of those same institutional investors, except pay a premium, and they say we can run it better if it's private. Then they hold it for a while, and then they sell it back to the market, and these private institutional investors, having paid substantial fees during the meantime, and say it's better to be public. I mean, it's an interesting exercise.
Let's talk about some of the things that came up this weekend that really caught people's attention, some of the more controversial statements that came out. At one point this weekend, you said that Bitcoin, and this was based, you were asked, Charlie said Bitcoin's like rat poison. You were asked about that comment, and you said, well, it's probably more like rat poison squared. Charlie went on in the meeting to then basically call Bitcoin turds.
He is an expressive sort, isn't he? Maybe when he gets a little older, he'll mature.
I just want to ask you about that because it sparked so much controversy, and particularly on Twitter and some of the places where you might expect people who are trading in cryptocurrency to be pretty loud about what they heard. What is it about Bitcoin that gets you guys so fired up?
Well, when you buy a farm, you look at the crop every year and what prices are, and you decide whether it was a satisfactory investment. I mean, you look to the asset itself and what it produces for you. When we buy a business, we look at what the business earns and decide how we feel about it in terms of what we paid. But we are buying something that at the end of the period, we not only have what we bought in the first place, but we have something that the asset produced. And when you buy non-productive assets, all you're counting on is whether the next person is going to pay you more because they're even more other next person coming along. But the asset itself is creating nothing. One of the interesting things, for example, is gold. If you go back to the time of Christ and you look at how many hours of labor you had to give up in order to buy an ounce of gold, and you take it forward to now, you'll find the compound rate maybe 1/10 or 2/10 of 1%. And then you have to insure it during that time and make sure somebody doesn't steal it from you and everything. But it doesn't produce anything. And productive assets, you can pay too much for a productive asset. But I bought a farm in the 1980s, and every year look at how much it produced, the way of soybeans and corn. And at the end of that period, I've still got the farm, and I've gotten some significant income off of it. Apartment house, operating business. But if you and I buy various cryptocurrencies, they're not going to multiply. They're not going to be a bunch of rabbits sitting there in front of us. They're just going to sit there. And I got to hope next time you get more excited after I bought it from you, and then maybe I'll get more excited and buy it from you. And actually, we could sit in a house by ourselves, and we could keep running up the price between the two of us. But at the end of the time, there's one Bitcoin sitting there, and now we got to find somebody else. And they come to an end. I mean, those.
That's a greater fool theory. That's what you're saying.
Well, yeah, it's buying something because you expect the pool of people who want to buy it because they want to sell it to somebody else will grow, and it's wonderful because it does create a rising price. Does create more buyers, and people think I've got to get in on this, and it's better if they don't understand it. That's the other thing about non-productive. If you don't understand it, you get much more excited than if you understand it. I mean, if you buy a bond that says it's going to pay you 4% a year, you're not going to get any pleasant surprises. She's going to pay you 4% a year. But if you can have anything you want to imagine, if you just look at something and say that's magic, you can do it with shark's teeth or seashells or anything. And they did it with tulips in the 17th century in Amsterdam, and they'll do it again. I mean, people, they like to speculate, they like to gamble, and if you can get something, particularly if you have something half plausible going on. If you had bought gold in 1942 and you say, we might lose the war and we might have to run off to some other country, and so let's put our assets in gold, you would have less than a penny for every dollar you got from owning stocks. Less than a penny. Now, if somebody calls that a store of value, I mean, I think they're delusionary.
Okay. Andrew, that's my whole entire point. I do want to ask Charlie about it because I think when he talked about the turds, he was referring to this. He said if you're trading this, it's like watching other people trading turds and deciding you want to get a piece of that.
Well, you're not going to get me to comment on that.
Hopefully Clearly, Charlie's not awake and
Well,
not watching
the truth is
right
people
now.
do trade on very crazy things over time. Imagine people selling their homes to buy a tulip in Amsterdam. If people think they're going to make money the next day, and worse yet, if they think somebody else that they know is going to make money and they aren't going to make money, it just draws people in. I could whisper something on this program, and kind of the more sillier it was, the more it might react, because there's no quantitative limits. If you buy a stock, you say, well, I'll buy it at 15 times earnings, but I won't buy it at 20 times earnings. But when you get into something that doesn't produce anything, there's no checkpoints. There's nothing to reference it to. It's just, it's gone up, so it'll keep going.
Now,
up.
I will say, when I was tweeting the things that you and Charlie were saying about this weekend, all I was doing was repeating what you were saying, and people were coming back with some pretty angry comments, including things like, I bought a house buying cryptocurrency. You're outdated on this. They said a lot meaner things, that you don't understand it, so you should shut up about it. You're not.
Well, the interesting thing is, if you're investing, you don't worry whether people say. If I'm investing in Apple, I love the idea of people saying Apple is terrible, because I want the stock to go down, because they're repurchasing shares and my interest will go up faster. You don't get defensive if you're buying something that produces that. You don't buy a farm and get real defensive if somebody comes along and says you shouldn't buy a farm or something. You say, look, once the crops grow and I can see what I'm selling my crop for at the end, and I'm making 4% or 8% on my investment. You get defensive when you look at this thing and it doesn't do anything. You're just hoping somebody comes along to pay you more tomorrow or the next day, and you're dependent on more people, the mob growing, basically. So those people do get angry. But the person that bought a house with it, I would say they did the very right thing. They sold it.
They sold it and bought something else with it. Hey, Joe.
Right now, Apple had whatever it did at the quarter, 4,927,000,000 shares, or 923 million, whatever it was. And we own about 5%. But I know I don't have to do a thing. Yeah. And probably in a couple of years, we'll own 6% without laying out another dollar. Well, I love the idea of having 5% go to 6%. And the cheaper the stock is, the more they will get for their money when they're buying it in. So there's just no reason at all for me to encourage other people to buy Apple.
What was that? I hadn't heard anyone say city service in a long time. Was that? It was a. Right. it was a preferred stock. It must have been convertible, wasn't it, or something, to have huge price swings?
What happened, Joe, was that City Service started out as a utility company. Kind of like it sounds. Way back around 1910, sometime around then.
Right.
But then they started developing natural gas, and then they found oil in connection with it. So over a period of time, it still was a big utility company. It morphed into a basic energy company, production company. But they issued, when they were a utility primarily, they issued a $6 preferred, that cumulative preferred, and it quit paying dividends in 1932. Like a lot of people, they ran out of money then. So from 1932 forward, you had this preferred, which $100 par, which was accumulating at $6 arrearages. The year before I bought it, they actually made a $3 payment on arrearage, but that still was less than a $6 coupon. And then they eventually called it at 200 and something, which was $100 par, probably a call premium, plus all the arrearages. It was not convertible.
I see. That's pretty amazing, though. You were 11 years old when you. And what a history City Service had. I mean, there's a Boone Pickens and a Pac-Man defense, and it was bought by Oxy. And then part of their gas stations were bought by Venezuela, remember? And they were giving free gas around. And the Red Sox, sure. The big Citgo sign up at near the baseball stadium. So it's amazing.
Right.
Yeah.
Right. No, it became a major oil company.
Yeah.
They actually, I think, sold the preferred door-to-door way back in the 20s or sometime like that too. But in the Depression, didn't have the money to pay it. Now all of a sudden it was paying down its debts, and it was going to earn a lot of money. And they had a lot of, they had assets that were becoming worth more. And we were going to have inflation after World War II, so that assets probably were going to be worth more while their debt was coming down. And the earnings on the preferred were terrific. They just weren't paying them out. So I was going to get $200 at some time, but the problem was that buying it at 38 and a quarter, as a matter of fact, and having it go down to 27, and walking to school with my sister, who also wanted to buy 3 shares because I was buying it. She hated to see me get rich while she wasn't getting rich, and having her point out that this thing was going down every day. When it got back up to 40, and we each had a chance to make a $5 profit, I thought, now my sister will again consider me a genius, and I will have $5 more. How could life be any better? So then I watched it go to 200 after selling it to 40.
Lessons learned early in life, probably very powerful ones. Warren Buffett's going to be with us until 9 a.m. We have a lot to talk about still. Once again, we are in Omaha with Berkshire's chairman and CEO, Warren Buffett. He's going to be with us through the entire morning. We'll be joined also by Charlie Munger and Bill Gates a little later in the program. But right now, Warren, let's talk through some of the individual stocks that you've spoken about this weekend. Maybe the most controversial one was Wells Fargo. You were questioned directly on that at the shareholders meeting with questions from shareholders and who have said, okay, and I did hear this from other shareholders later on, Wells Fargo has run into trouble time and time again. The fines have continued. The developments and things that we found out about, some of the cockroaches, as you might phrase, continue to come out. But you've stuck with this stock and said that you're not selling and that you have faith in Tim Sloan, who's the existing CEO. People have pushed back and said, look, this is a company that's run into trouble and it doesn't jibe with what we've heard you say about Solomon. How do you say, yes, this does fit with our investing philosophy?
Well, at Wells Fargo, they made one mistake that maybe I've made from time to time, which is incentives work, and they came up with improper incentives, and they worked, and so they incented bad behavior instead of incenting good behavior, and that happens from time to time. You can put too big a commission in something or the sort.
But let's talk very specifically about what incentives were created. They were incentives that rewarded people for the number of new accounts that were opened. They regularly on their investor presentations would say we've got so many, and 8 would be great, and 6.2 was better than 6.1 products. So they put this huge emphasis to the public out there, as well as to the employees, but to the public, that they had more services per to their shareholders,
and shareholders, and everybody to listen. And surprise, surprise, people started creating fake accounts, and when bad behavior gets in there, other people figure it out. I mean, if you get rewarded for bad behavior, you're going to have a lot of bad behavior. That's a problem. I'm sure it's a problem we've had from time to time in Berkshire and other places. But the real problem was, when you find out about it, you've got to stop it immediately. I don't know the details about why it wasn't stopped, but I've seen that before. And then it just gets out of hand. And if you don't stop it immediately, then if you do it 4 months later, everybody will come and say, well, why didn't you do something 4 months earlier?
But let's be a little more pointed with this. This was not just a case where Wells Fargo was not stopping bad incentives immediately. It was quashing whistleblowers who were behaving properly and firing them.
I don't know the details too much on that, but
from what's been reported, I don't know this firsthand. I don't know this firsthand, but from what's been reported, there have been many whistleblowers who said that they were trying to do the right thing. They tried to report it, and as a result, they wound up losing their jobs.
Once you have not done it, you're in the soup. I mean, John Goodfriend in April of 1991 got word that Paul Mosier, a trader in government bonds, was doing something that was very wrong. And he absolutely, John was not profiting by it, he didn't know about it, but the next minute he had to pick up that phone and call Jerry Corrigan at the Federal Reserve of New York. And everybody thought he was going to do it in the room, but it was unpleasant, or he got distracted. And then on May 15th, Mosier did it all over again, and now the position you're in is you call up, and you knew that this pyromaniac was out there who would set fires, and you let him ride another match, and then you're in big trouble. Anyway, you have to act. I mean, Charlie's been very good with me on things like that. If I tell him about anything that's a problem, I mean, he doesn't let me procrastinate, and I might procrastinate otherwise. It's a very human trait. But anyway, and then they uncover other wrong things as you get into it. Now, a couple of our great opportunities came from similar situations. I mean, Geico had a CEO in the early 70s who refused to accept the fact that the loss reserves were developing badly. Now, if you refuse to accurately assess your loss reserves, you also don't know your costs because you sell the product first, and then you start kidding yourself on the costs. And then you get in a hole, and now your reserves are, and maybe you figure it out, but then you've got to admit it if you do it, and it's just easier to shut your eyes and hope that something good happens, and it essentially bankrupted the company. Now, that was a huge opportunity for us because Geico was a solid company underneath, but their balance sheet was a mess. They needed to raise capital. They almost got their licenses withdrawn, and we bought half the company for less than $50 million. So the fundamental business that Wells Fargo, they've still got the accounts. They've got the loan customers. We do business with them every day. And incidentally, other banks ran into many other kinds of trouble in the 2008-9 period, more on the selling bigger stuff, maybe mortgage-backed securities or something of the sort. So the banks had their share of trouble, but Wells had theirs in a particularly egregious way, which was really kind of thumbing their nose at the public. They made way, way, way less money doing that than if they were bundling big MBSs and raking it in by the tens or hundreds of millions, and the fines were big, even bigger. But going forward, you can stop bad practices. They should be stopped earlier, and they're much easier stopped.
I look at the situation with Solomon, and you came in and were the person who had to clean it up. Tim Sloan was an insider. Tim Sloan was not the one who
Yeah, he'd been an insider there. Sure, he was one of 7 or 8 people that were top people I interviewed. I had to have an insider because I arrived there on a Friday, and they were talking about closing us up. And somebody had to run a business that was doing maybe hundreds of billions of dollars worth of business and things like government bonds and everything. We had the largest balance sheet in Wall Street. So there was no way I could wait and get an outsider. I interviewed people on a Saturday. I started interviewing at 9 in the morning. I got in on a Friday. And I had to come up with somebody by Saturday afternoon to run the place. And there were people in that room that had semi-contributed to the culture anyway that had led to this activity. And so I picked an insider who knew about it, knew all the people involved, and the guy behaved magnificently and got me out of trouble.
Joe?
Institutions make mistakes, and I will tell you this, we have 377,000 people working for Berkshire, and right now, I don't know whether 5 of them or 10 of them or 20 of them, but I'll guarantee it isn't 0 of them, are doing something wrong. And my job is to act when I hear about anything, and to make sure we've got some system so we do hear about things. So we get about 2,000 contacts through what we call the hotline a year. I get anonymous letters, and those are the 2 best sources of finding out where something's wrong. I mean, it's better than having 100 people crawling all over the books. Anonymous. Oh, they're not. Sometimes they sign them, but I received one last week, and
You received one last week about something happening at Berkshire?
Yeah, sure. But I mean, I receive them all. I mean, they're going to come in, and sometimes people just don't like the person working next to them, so they come in for a lot of frivolous reasons. But you have to look into what it is, and if you look at 100, and 99 or the guy next to me has bad breath, or something like that, but. That's the way you do find them, overwhelmingly, is tips, basically.
How do you track down every one of those tips?
Well, we have an audit department that sorts out the ones that they think that I ought to see. I mean, so Becky Amick is in charge of the audit department. And incidentally, the larger companies, they have their own groups, too. But those people can not only write their own company, but they can write us. And some of them just come into... a letter comes into Warren Buffett, chairman. It's usually not signed, but that's okay. I mean, and obviously when they get very specific and say this is going on or that's going on, that's what happened with American Express in 1964. They had a field warehousing subsidiary. they were getting calls from a guy at a bar in Bayonne to the head of and he was saying the tanks are phony. Go to this tank and go to that tank, and you will find that it's not filled with salad oil. And the guy didn't want to hear it, and he didn't want to tell his boss, and it just gets worse and worse and worse.